Welcome back, everyone. Today, we get to look at how powerful the Fed's words really are. Your mom's always told you sticks and stones may break your bones, but words will never hurt you. But when those words come out of Jerome Powell's mouth, they definitely hurt. Um, so, what the Fed does and has been doing for quite some time now is they like to massage their incentives into the market. They like to massage their plans into the market. They don't want them to just be released quickly without anyone knowing. They saw that in the 1980s when we saw ridiculously high inflation, when we saw ridiculously high interest rates. No one had any hope. No one had any economic outlook. No one knew what how the markets should be, how the economy should be. And so the Fed changed from then. And they like to sneakily put these little words out, these little birdies out into the market in the forms of articles. And so they'll go and they'll release these articles through the Wall Street Journal, through Bloomberg, and say something like, uh, "This analyst is expecting a 50 basis point hike. This analyst expects interest rates to hit 6%." And today we are going to look at one of those articles and see what the Fed is saying behind the scenes. So let's get right into it. So let's start off. Fed officials have already indicated they are likely to raise federal funds rate by 75 basis points. This has been priced in the market for quite some months now. So let's get into the good stuff, right? They are potentially going to start reducing the size of increases after this week and potentially stop lifting rates early next year so they can see the effects of their moves. Right? They have made a bunch, 4 straight quarters of 75 basis, well, going to be 4 straight quarters if it happens tomorrow, of 75 basis point increases and not giving themselves any time to see if it's working. And it seems like it has been. And that's where we see people come and say stuff like, you're trying to cool the economy, not throw it into a deep freeze or supersize rate increases. Okay? This is because they're playing catch up. The Fed is not perfect. Shockingly, right? The Fed's definitely not perfect. So they are playing catch up right now, and we are seeing it play out poorly. Okay. So, right, this kind of goes back to the new data that's going to come out. Um, we will see more jobs reports and more CPI data come out in between this meeting and the December meeting, which are very crucial to look at. This meeting doesn't have a lot of um, information to go into it as much as the December one will. So that's kind of where we see um, a natural time to slow the pace because officials could use new projections to show um, the economic outlook for the next year. And that's really important, is actually basing it off data, CPI and jobs report. So that's going to be very crucial when those things come out because that could affect the 75 BP basis point hike or a 50 basis point hike. So what happens if we see the data come back worse than expected? Well, some analysts expect that. And they say it will be difficult for the Fed to dial back the rate increases in December because inflation will continue to run hot. Frowny face, right? So in September, the Feds expected that the target rate would have to be 4.6%. Now it makes sense to get to that peak faster, sooner, which would require this to not be the peak, but just a little dot on our way to the peak. And if inflation keeps rising and the Fed can't dial back, then we could potentially see some big numbers like 6% by next June. Personally, I do not see a 6% in our forecast. I do see a 5.25% in our forecast. But they like to remember this is the Fed saying this is the Fed saying this. So they like to throw some stuff out there and see how the markets react. So they'll throw in the 50 BP hike. And they do this because they don't want the markets to get higher. And we'll kind of go into that in a second. You'll see why. But they like to throw in these things to see how the markets react. And that's really crucial. So you see here, right? The Fed could slow in December, then still get to the 6% forecast. And we'll kind of see why. So let's get to the basics, the very basics that we all know and love. So the Fed slows the economy by tightening the federal funds rate and other financial conditions, such as higher borrowing costs. They lower the stock prices and strengthens the dollar, right? Now, lowering stock price, that's a big one, especially for us investors. What would the lowering the stock price do? A market rally risks undoing the Fed's work of slowing down the economy, right there in the blue. So they don't want a market rally, right? It would undo all the work that they have been working so hard to do. And so that's why they like to ease these things into the market. Because if they just came out and did a 50 basis point hike, we'd all be like, oh my gosh, it's over, right? Well, they can still do a 50 basis point hike. And they can do another one and another one and another one and still get to 6%. So a much higher rate path could temper market exuberance about a slower pace of increases. So they want to come out and they want to, they don't want the markets to rally, essentially. We can have these bear market rallies that are necessary when the hedge funds have to cover their short positions. Those are necessary. But they don't want an overall bull market rally here because they still see pain to come and it would undo a lot of their work that they've been doing for the past year now. And so you got to really keep in mind, like, who genuinely controls the markets, right? The Fed, the government, these hedge funds. So you have to understand where they're coming from if you want to see how these trends really work. Well, yes, thank you guys for watching once again, hopefully. Hope you enjoyed the video, went over some great details, and thank you, and tune in next time.